What's going on, everybody? In this video, we're going to be talking about how to invest based on your time horizon, how much time you expect to be investing before you do plan to live on your dividends and such things like that. So we've got a lot to talk about in this video. I even have made up some portfolios using M1 Finance. If you haven't already, sign up using the link in the description down below. If you sign up and deposit some money, you'll get free money back. So might as well check it out while you can, and you could potentially go ahead and use these portfolios that I've built. Although, remember, I'm not a financial advisor, and to be quite honest, I don't really recommend that you take these portfolios that I've built. If you're going to use any portfolio, I would recommend using the portfolio that I have right here, but everybody's got different investment time horizon. I'm sure you and me have different time horizons on how long we plan on investing, but let's go ahead and just get straight into the video on how to invest based on your time horizon. So before we do talk about me kind of telling how to invest with your base time horizon, I want to say there's a few assumptions that I've made in order to kind of get up with the idea that I've made for these investments. So the first assumption is going to be that you're dollar cost averaging into your portfolio, rather than, let's just say, for example, you had $10,000 in your bank account that you wanted to use. Instead of just putting $10,000 into an investment account and never putting any more money in there, you are putting money in consistently, maybe every week, every month, whatever it might be, but you're dollar cost averaging into your portfolio. Second is you are reinvesting your dividends. So for all the dividend income that you are making, you are reinvesting it. So if you got $5 in dividends this week, you're taking that $5 and putting it back into your portfolio to make sure that you're getting more dividends in the future, at least until you plan to live off of your dividends. Third is you're retiring at age 62. So this is the national average, and you might be retiring older, you might be retiring younger. Really depends. You might not even plan on investing until you retire. You might want to live on your dividends before you retire, after you retire, whatever it might be. But this is just the assumption that we're making. And fourth is the market continues to uptrend. You kind of have to make that assumption that with your investments, the market is going to continue to go up, especially over the long term, because if not, if nobody had that assumption, you wouldn't be investing. But let's go ahead and talk about kind of some targets. So here's some kind of ranges. Let's say you're 0 to 5 years from planning on living off of your investments, maybe retiring, whatever it might be. You should aim for roughly 4% to 7% dividend yields and an EGR, which is expected growth rate, of 4% to 7%. And that EGR pretty much would be every year you expect your investments to go up 4 to 7%. And these are kind of the exact same numbers. Most of the time it's not like that. The closer you are to living off your investments, the closer you are to, we'll call it retirement, is whenever you're going to want to get higher yield and lower growth. And we'll look at a calculator in a little bit and kind of show you why, like kind of the math behind this, and why you shouldn't just take a high yield from day one. But let's go ahead and talk about what if you're 6 to 10 years from being ready to live off your dividends. I say you aim for roughly a 2.5% to 4% yield, an expected growth rate of anywhere from 7 to 10%. And one thing to kind of keep in mind is these are just numbers, these are just assumptions to kind of keep you in that ballpark. Don't go out there and just because you watch this video, if you plan on retiring in 7 years, don't only go out there and buy a stock if it has an expected growth rate of 7% to 10% and a yield of 2.5 to 4%. These are just ballpark ranges. I kind of want to give you guys an idea. I don't want you to go to blindly doing stuff, but you don't want to necessarily complete a strict, I don't think it's a good thing to be so strict on your investments that you're missing out on potential opportunities elsewhere. These are just ballpark ranges, so keep that in mind. And then next up is 11 to 20 years. So if you have a yield of about 1% to 3.5%, that's about what you want to aim for if you're 11 to 20 years away from investing, from being a dividend income person who lives up to the dividend income, and expected growth rate of higher than 10%. And 20 plus years would be a little bit of a lower yield, 0.1% to 3%, and an expected growth rate of 10%. And in order to kind of capitalize on all these opportunities, it's really important that whenever you go and you do invest, you make sure that you're reinvesting your dividends, your dollar cost averaging, you're being consistent with your investments. But let's go ahead and look at some calculators to show you kind of why I've come up with these numbers. So here's a pretty simple calculator, very simple. We're going with an assumption of an investment amount of $10,000 up front and an annual contribution of $6,000, which is going to be $500 per month. Distribution frequency, that's just pretty much how often you get paid the dividend, so quarterly. And we're going to go with a simple math rate. I just want to show you kind of the reason why you shouldn't always aim for high yield if you're far away from planning to live on your dividends. And you probably shouldn't aim for low yield and high growth if you're close to living on your dividends, So in this one, we're expecting 20 years of a holding period. Dividend reinvestment is happening. And we're having an expected annual dividend increase of 2%, a yield of 5%, and an annual increase of 4%. So we're expecting our stock price to go up by 4%, getting a yield of 5%, and expecting the annual dividend increases to go up by 2% every single year. And if I calculated this, that's going to add up to an ending balance of $391,000, which is a lot of money, okay? You're getting a total annual dividend income of about $26,700 almost, which is really good. You're getting a good yield on cost, but you're 20 years away. So if we do that 20-year, we kind of go with an expected yield. What if we went with a 3% yield and we went ahead and expected 8% growth, And usually with these companies, you're going to get higher dividend yield growth. We'll go with a 2.8% dividend yield even. And everything else remains the same. Same amount of money, same amount of time. And if we calculate that over a long-term period of time, a 20-year different period, you ended up with $567,000. So that's kind of the difference on why you plan on letting things grow over the long term and then slowly shifting into a higher yield whenever you need the yield. Because now your annual dividend income is way higher, and it's because you let things grow, you let things compound, and your annual return was almost up by 7% more, which is really big. It's up by like 6.5% more. But still, that's really, really good. Your yield on cost, everything like that. It's all about knowing your time horizon to capitalize on the opportunity that you are given. And everybody's investment time horizon is different. But to kind of close this video, I want to show you some stuff that I made. So as you can see, I made a few pies on M1 Finance. I made 3 pies. Now don't kind of think that these pies are me doing hours upon hours of research. These are just me kind of throwing in some portfolio, some dividend ETFs, and honestly just ETFs in general that I know of that are said to be pretty good, and a few of them I do own myself. But this is kind of, if you want these, I'll go ahead and put the link down there in the description to each of these, so you can go ahead and check it out. Check out M1 Finance as well. But this is kind of the high yield. So if you're looking for higher yield right now, we have some holdings like XYLD, JEPI, QYLD, and you can take this portfolio, edit it. You can just use it as an idea, whatever you want to do with it. But this is pretty important, in my opinion, just to kind of see. This portfolio right here has a dividend yield of 8.311% and an expense ratio of 0.26%. So it's a really high yield. But if you look at the growth, it's not that high. It's actually been negative over the past few quarters in the past year. But that's simply because, the market's been down, and especially with this yield, you're technically getting a gain of like 3%. But let's go ahead and talk about the second one, which is going to be mid yield. And the growth on this one is better, lower the yield, relatively speaking. If you're doing it correctly, you should be getting better growth. This portfolio has a yield of 3.235%, an expense ratio of 0.14%, has 3 different ETFs, SEHD, SPYD, and SPHD. So some pretty good holdings. I do actually own all 3 of these. But let's go ahead and talk about the third and final pie that I created, which is going to be the low yield pie. It has the highest growth, and it's been growing pretty high. Over the past year, it's pretty flat, simply because, the market's been kind of crazy. But you can see the growth has definitely been there before. Has a yield of 1.857%, an expense ratio of 0.15%, which is slightly more than the middle one. And has 4 holdings, has DGROW, DGRW, SPY, just the S&P 500, and VIG, which is Vanguard Dividend Appreciation ETF. And this is kind of just some simple calculations for looking at dividend stocks. I'll put the link down in the description or the pinned comment down below. So you can go check out these pods if you want to. Go check out M1 Finance if you haven't already. Use the link in the description down below or the pinned comment. Get yourself some free money. But that's going to wrap it up for this video. Thank you for making it all the way to the end. I really appreciate it. Subscribe to the channel if you're new. Really helps me out and just helps out the channel in general. Give the video a thumbs up, leave a comment, all that good stuff. And I will see you at the next video.